Hello, good evening, everyone. So, this is Aman Krishan from Team Taxmann, welcoming you all to today's live session on tax conundrums in insolvency and bankruptcy acquisitions. I would like to start with a brief about Taxmann. We are the leading publisher of tax and corporate laws in India. We maintain the largest and the most accurate online database on income tax, international taxation, GST, company and SEBI law, IBC, FEMA banking and NBFC, competition law, accounts and audit, and Indian acts and rules. Over the years, we have worked strenuously to offer the solution that will continue to help you grow your practice. Our 6 decades of experience in the domain has helped us to constantly innovate and enhance our services to take the tax practice to newer heights. We also have developed the national website of the income tax department, and we maintain it with the help of our tech team and the editorial. I now welcome Mr. Vishwas Panjiar. Mr. Panjiar has considerable expertise in M&A, estate planning, corporate and international taxation, company law and exchange control matters, and has been involved in providing advisory services on taxation and structuring for various Indian and foreign companies. He has a rich and varied experience of over 18 years to the Indian tax and regulatory system. He is a regular speaker at professional forums and business associations. We are pleased to have you with us, sir. Now, before we proceed, we have a few tips for the participants. Firstly, your mic will be on mute. Secondly, you may post your questions in the chat box given on your right-hand side. Thirdly, your questions will be answered by the speaker during the session or after the session by the R&D team. A copy of the presentation on the subject matter shall be sent to you in email for all of your future references. Oh, okay, so now without taking any more time, I will request Mr. Vishwas to address the audience and proceed. Over to you, sir.
Many thanks, everyone, for joining us this Saturday afternoon. And thanks to you, Aman and Naveen Vadwan, the entire Taxmann team, for giving me this opportunity to talk to you all. Most of all, thanks to my colleagues, Amit, Parul, Bhaskar, and Utkarsh. People in my position tend to get disproportionate credit. It's the team which has done most of the heavy lifting for this session. Well, as Aman mentioned, I am Vishwas Panjiar. I'm a partner at Nangia Andersen, the Indian member firm of Andersen Global. You'd perhaps know that almost half of the companies who enter into the CIRP or the IBC process in India end up being liquidated as opposed to getting a real resolution or a turnaround for which the law was made. But what you perhaps don't know is that tax provisions, or rather the lack of it, may be contributing to pushing the companies to liquidation. In this session, I intend to discuss some of these points. IBC has taken a center stage in the recent years, being a hot topic of discussions and debates. I would encourage, like Aman mentioned, to people to participate, ask questions, give your views in the chat. Otherwise, it will end up being a broadcast which and end really quickly. I will try and take up the questions in between also, but definitely at the end of the session. Right. So now to begin with, what is IBC? Now, most of you may already know, so I will very briefly discuss the evolution of the law itself, mostly to set context of some of the points which I will discuss later for you to better understand or appreciate the actual topic of discussion, which is the tax conundrum and acquisitions made through the IBC process. IBC, or Insolvency and Bankruptcy Code, was introduced as a unified code to tackle insolvency of various forms of entities. Before the code, there were various legislations which dealt with insolvency. There was Companies Act, CIRP, recovery of bad debts due to banks and financial institutions, SICA, several others, presidency towns, insolvency, etc. IBC Code didn't only seek to provide a single legislation, but it also sought to achieve much more, which is also actually mentioned in the preamble of the law itself. It was intended to be a time-bound resolution, mind it, not dissolution. Dissolution is actually the last form of resolving any insolvent entity, right? You put your pet to sleep only when nothing else work. None of the other medicines or none of the other resolutions work. So dissolution of a firm is not really the intention of the law. The preamble also provides that it is meant to maximize the value of the assets, to promote entrepreneurship, to encourage availability of credit. If the recoverability is ensured, it will encourage availability of credit. And also, the last but definitely not the least is to balance the interest of all the stakeholders. To put things into perspective, IBC was enacted to fix a looming problem of debt recovery, as even a traditional winding up process entailed protracted litigation in several years. Just to share some stats, the average resolution process before the IBC was ran into several years. The recovery rate, the debt due versus the amount actually recovered, was less than 25%, and the recovery process or the dissolution process was involved high cost, and the exit from non-insolvent businesses was not easy at all. Now, even in these 4 5 years of existence that the IBC law has been in existence, it has been evolving, especially considering that it tends to be all encompassing and a very, so to say, a nascent law. There have been various amendments that have happened. One of those, I'll just talk about a few significant ones. For example, inclusion of home buyers. Home buyers are typically, so to say, customers, but they were included in the definition of financial creditors. It has itself had mixed reactions, since in a lot of cases, home buyers have been left with nothing. Actually, they haven't got their homes and they haven't got their money also. If you ask me personally, actually, dissolution is not at all an option for a real estate developer, or especially in the residential category. It's not really an option at all. Other changes in the midst of COVID, where you're aware that there was, because everyone expected a lot of insolvency cases to come in, and all the debts were mounting. So there was a period of 1 year since lockdown that this law was suspended. To address the issues, because the resolution processes were taking time, because earlier the requirement was 75% of the committee of creditors who actually vote on the resolution plan. There was 75% had to agree. Now that has been reduced to 66%. Maximum time limit of 330 days has also been put in for finalizing the resolution process. However, that's seldom met actually. Pre-packed insolvency has come into being, and now some provisions with respect to cross-border insolvency has also come into being. Let's look at the current outlook of the code. It's been 5 years. Let's take some statistics, and let's look at some statistics. As it is very evident, there are a lot of hits and misses in the overall scheme of things. Much has been talked about excessive haircuts and the extended timelines, the timelines taken for the resolution in this process. However, a lot of consideration has to be borne in mind before reaching to these conclusions. IBC has actually helped credit culture in the country a lot. You may see that IBC has resulted in significant deleveraging by listed entities. IMF has suggested that while looking at the recovery rates, different category of creditors, secured creditors, unsecured creditors, should be treated separately because of the differences in their claims. Moreover, there is no benchmark for recovery rates. They are very widely, even across the OECD countries, and in turn, a function of the time taken, the associated costs, macroeconomic conditions, and the legal rights of various parties. At the outset, judicial delays are there, and more than 71% cases in the NCLT took longer than 180 days to decide. One of the reasons could be the vacancies in the tribunals or the general capacity building. Because it's a new legislation, there is always a learning curve, and it's a very specialized commercial matter. Training of experts adjudicating these matters, professionals, resolution professionals, and other professionals who are engaged in this are also there. Everyone takes time to come to terms with this new law, and which has made quite a few significant differences in the law that existed before. In fact, sessions like these is also intended to support this capacity building and create an ecosystem required for faster and most effective implementation of the code. In total, what you'd see is about out of around 3,000 cases, 1,640 cases have been closed, and the recovery is over 2.5 crores. Around one third of the admitted cases have actually been closed, making significant shift in the insolvency resolution process and credit culture in India. The actual recovery was approximately 1.4 times the liquidation value. Liquidation value is the as probably you already understand, the asset value of the company, not as a going concern, but as the asset value. The recovery has been more approximately 1.4 times of the liquidation value. However, the cause of concern is actually the percentage of resolution still. If you see on the right column, the middle box in the right column, the second row in the right column, 46% of the cases have gone to liquidation, and this is what we want to discuss. What we want to discuss is whether tax has been a contributing factor to this, or let's put it more constructively, how can some changes in the budget, which is scheduled on Tuesday, help in the resolution process? Now, the road so far with respect to the amendments in the Income Tax Act with respect to companies under IBC. Whenever a new law comes in, especially a path-breaking one like the IBC Code, it needs enablement. You can't just make a law. You have to enable it by giving it some supremacy over some of the existing laws. If everything was to function this way it was before, then the new law would be very ineffective. The aspect of giving an overriding effect to IBC itself it comes by virtue of Section 238 of the Code, and it has been actually a matter of debate and also a litigation. Some of the famous ones, the Supreme Court in case of Monet Spart, PCIT versus Monet Spart in 2018 itself, upheld that as per the provisions of Section 238 of the Code, you have to give precedence to, or you have to have, the code has to have overriding effect of all central and state government statutes, including the Income Tax Act. If I may quote, it said that given Section 238 of the IBC Code, it is obvious that the code will override anything inconsistent contained in any other enactment, including the Income Tax Act. Important thing to note is that the IBC will only override other laws to the extent it is inconsistent with the IBC. Another significant impact of IBC on the income tax law is regarding the recovery of the tax due itself. As a part of the resolution process, the resolution applicant or the acquirer who wants to acquire or who intends to acquire the stressed company, I mean, it's the corporate debtor, and the potential acquirer is the resolution applicant, is required to submit a resolution plan for the revival of the corporate debtor, which is first approved by a negotiator and then approved by the committee of creditors, the creditors who to whom the corporate debtor owes money, and then also approved by the NCLT. Once it is approved, it is binding on all parties. The resolution plan would obviously typically provide for haircut for all outstanding, most of the outstanding dues to various stakeholders. Whether it's operational creditors or financial creditors, everyone goes through a haircut, because if those debts were sustainable, the company would not have been in insolvency. Even the income tax dues also goes through a haircut, as they are also the tax dues are also regarded as operational creditor. IBC also provides for a moratorium from the date the matter is admitted by the NCLT. The short point is that the tax proceedings, including litigations before appellate forums, would have to be kept at abeyance during this moratorium period. In certain cases, as an exception, some of the proceedings may be permitted to continue with the necessary direction of the tribunal. However, even if they continue, they cannot result in an actual tax demand or recovery of the tax. The tax dues can eventually only be recovered by like any other operational creditors. Recently, actually, in the case of Sirpur paper mills, it was held that the period of recovery by the resolution plan income tax department cannot carry out any scrutiny or assessment in respect of the corporate debtor. Therefore, the debate over the supremacy could still prevail, and it can be concluded that IBC will prevail over the provision of the Income Tax Act, but only to the extent it is inconsistent. Well, there have been actually some amendments which in the tax law, which you can see. However, I would say they're half-baked, or they come with riders which make it a lot ineffective. First, in 2018 itself, there was a provision to suspend the application of Section 79. Now, Section 79 of the Income Tax Act is an anti-abuse provision which intends to curb the taxpayer from attempting to acquire loss-making companies and enjoy the tax benefit of loss that were incurred by other stakeholders. Basically, if the shareholding of the company changes beyond 51%, then those tax losses expire. That's the general rule. But in a resolution process, obviously, in most of the cases, actually, obviously the change in the shareholding will be to the extent of more than 51%. However, this amendment suspended this provision, application of this provision for companies which have going through an insolvency process through the court. How again this comes with the rider. The same is subject to the condition that the jurisdictional principal commissioner of income tax has to be provided an opportunity of being heard. The loss in such cases obviously can be carried forward only if only after giving such an opportunity to the principal commissioner of income tax. MAT, as we all know, was introduced to tax companies based on their book profits when these companies are not paying tax under the normal provisions of the law. As a measure for a resolution of the distressed company, it was also proposed that that Section 115 JB of the Income Tax Act, for calculating the book profit on which this MAT is to be levied, the aggregate amount of the loss and the depreciation, and not the lesser of the two, which is what is applicable to other companies, would be allowed to be reduced from the book profit for determining the book profit on which the MAT has to be deducted and has to be applicable. In 2020, these are the amendments in 2018, but in 2020, some of the rules were amended, which were with respect to some of the valuation, the deeming provisions that was applicable. Section 50 CA, which imposes a tax on the notional value basis on the seller in case of transfer of unquoted shares. That notional value is a prescriptive fair market value calculation system. That your consideration will be assumed to be that fair market value if you're selling it below that. That's not that's not applicable in case of unlisted companies. 56(2)(10) imposes on the recipient side. This is on the recipient side. If somebody was to receive shares at a value lower than a prescriptive tax value, tax prescribed fair market value, the difference, the discount that you get that will be taxed in the hands of the recipient as other sources. This was again, there was a carve out made, and companies which are going through the share. If you receive shares of a company, unquoted shares, unlisted shares of a company, which is going through a resolution process, even if you receive it below such fair market value, the same was not taxable if that company, if you've acquired it through the IBC process. However, both these provisions, again, they are again subject to, or after giving an opportunity to oppose. The tax authorities have to be given an opportunity to oppose this. Now let's look at. I can see some questions. Let's try and cover this aspect first. I think this is quite interesting because I can see some of the questions are from young professionals. So this will be interesting. Acquisitions of companies which are going, acquisitions in general involves several considerations. It's a very structuring that and planning that is a very interesting exercise, let's put it that way, and involves a lot of factors. Acquisition of a company through an IBC process, it's only makes it more interesting. IBC resolution or acquisition process is a lengthy bid process where eligible resolution applicants, like I explained, resolution applicants are prospective acquirers who apply to acquire a stressed company, which is going through a resolution process. These are selected basis on there is a evaluation matrix which comes out. Evaluation matrix is released by the resolution professional, the RP, which is running the business and running the process on behalf of the creditors. They release a evaluation matrix and a process. So you have to score in that matrix and be the winner in that process to be able to acquire the company. Resolution applicants have to obviously then structure the resolution plan, the plan that needs to go in. It's a document, a plan which involves several things. It's just not an auction. Though it's a bid, you have to submit it as a plan which involves various other things other than how what value you're delivering and how. There are various other things that also comes in, and that has to score well in that evaluation matrix to be able for you to be successful. And therefore, you have to go through. You have to use various structures and various things to be able to maximize value. The prospective acquirer is actually at full liberty to structure the resolution plan, which is there is and that plan has to be approved then by as I said, by the committee of creditors. They will each member of the committee of creditors will see their own interest, and you have to get it passed by more than 66%, and also get it approved by the NCLT, the tribunal. And tribunal is responsible for seeing that it is fair and it is in compliance of all the law, and it has gone through a just process. So that's the whole process of getting a resolution plan approved. Now, since it is going through such a process, obviously to design it itself requires a lot of skill. So any person seeking to acquire a target meaning the company which is under resolution, has to bear in mind various legislations and dimensions, and so that the value is maximized to the corporate debtors and you get picked up. It's not only giving good value to the creditors, but you should be the one who gets picked up amongst various people who bid. It involves, obviously, as I said, commercial and legal considerations. The designing of a resolution plan, which is a plan submitted by the prospective acquirers in response to an invitation for bids, is a very intricate and, I must say, very interesting process. I already said that it's an interesting process. In fact, since I see a lot of young professionals also on this, hearing this, I would like to take this opportunity to encourage young professionals in the audience to explore this professional opportunity. One might think that the IBC code or this new law only gives you an option of being a resolution professional, an RP, which is what a company chartered accountant or a company secretary can become. Other professionals can become a resolution professional by passing their exam, and that's the only way to get involved in the IBC in this law, by this new law. But that's not actually true. Assisting a potential acquirer, there are various other opportunities, like for example, assisting a potential acquirer to make a winning bid or to make a resolution plan. That itself is a very, very good, very, very big opportunity. Making a successful resolution plan needs to, some of the items you can see, but I'll quickly walk you through it. A resolution plan needs to take into consideration several commercial and legal aspects, how you're delivering the resolution value, how much to pay, how to distribute, whom and when. Some of the most important decision factors. It's a tight rope walk, actually. It's a very tight rope walk, because you have to make a most compelling plan, which is attractive to the committee of creditors, and yet it should be a value proposition for the acquirer, for the client. For example, if you're acting for a client to make a resolution plan, it has to be a great value proposition for the client. He should be able to get it at the best possible value, which is the lowest value possible. But at the same time, you have to make it compelling so that it is the best possible value that creditors are going to get. So they are pulling in different directions, but that's why I say it's a tight rope walk. Some of the other things is that if the corporate debtor or the company itself, which is going through a resolution process, which you intend to acquire, is a listed company, then whether to stay listed or not listed itself is a strategic decision. Again, it has various commercial, tax, and legal considerations. How the resolution value, the value that you have decided to deliver to the creditors, how that will be delivered, and what instruments to consider itself also, that also requires a lot of consideration. What is important to note is that secured creditors, and they tend to be the largest chunk of the financial, the creditors who comprise, who are in the committee of creditors. They are the ones. They are your voters. So they tend to, the secured creditors are the largest chunk. There may be various secured creditors. Now, they would not vote in favor of a plan if the value that you're delivering to that particular or that particular creditor is lower than the liquidation value, right? So if it's lower than liquidation value, then he might as well sell the security, the security he has and get that value, right? So he will never vote in that favor of that. Therefore, you have to be, you have to carefully estimate what would be the liquidation value and what you should offer to each of the creditors. Corporate structuring itself, the overall structure of the acquisition also has a major role. I mean, just giving us a small example, a lot of these acquisitions you must have seen is actually being done through an SPV, not the main entity, but a subsidiary that does the acquisition. For instance, in the Tata Steel acquisition of Bhushan Steel, it was actually done through a subsidiary called Bhamnipal. It's a much smaller subsidiary, though. I mean, the actual funding may have been coming through Tata, but it was the actual acquisition of Bhushan Steel was done through a subsidiary, Bhamnipal. And then these SPVs in some instances, like in the Tata Steel instance, also gets merged into the company which is an acquired, resulting in a direct shareholding of the ultimate company, the main company holding the shares directly of the acquired company. So there are quite a few commercial and tax and structuring drivers to take the decisions. So, as a part of the resolution plan, prospective bidder or the resolution applicant needs to propose a plan for resolution of the companies capturing all, how the liabilities of secured creditors will be paid, how the liabilities of unsecured creditors will be paid, how and, how much also and when, how the operational creditors, any other stakeholders will be discharged. Everything has to be planned. To be honest, how a resolution plan needs to be structured is what things to consider while structuring a resolution plan would be a long session in itself. I just wanted to give you a glimpse of what is involved. So and because there is a tax interplay in everything, in all of the decision makings, and which you'll see now. When we go through that, so there's tax implication of all of that. So I just wanted to give you a glimpse of what are the moving parts while deciding a resolution plan and what we need to consider. Now, coming to perhaps the core or the soul of this session. What are the impediments? What are the challenges? Now, while it's been already been 5 years, and there have been some relaxations, but as I said, there are still quite a few contentious issues which need to be addressed. An acquisition through a CIRP process, why is it so attractive? Other than the value aspect that, if a stressed asset is you're likely to get it at a lower value, but what makes it most interesting? If acquiring a stressed company from the market, which has not going through an IBC process, versus acquiring the same company which is already going through an IBC process, there's a big difference. The difference is that the law provides that you get relief from all the past baggages. It's what I like to say is that it is, if you acquire a company, if your company has gone through an IBC process, it has been rebaptized, let's put it that way. And you get a new life, and all the past issues, and you get an indemnity from all the past issues. However, what happens is that the issue is that some of the tax baggages, while you are able to get rid of all the excess baggage or the wrong baggages that the business was carrying on, those are most of it actually are you're able to get rid of them, but the tax baggage seems to carry on. For the acquirer, these ambiguous tax areas may make it a very unviable acquisition. There are multiple areas where current tax issues there's a roadblock. The first one, I think this may be a little cliche. It's been talked about a lot already, but any resolution process, would involve write back of liabilities. If that company had taken a loan of 100 rupees from the banks, if it had the ability to pay 100 to the bank pat, it would not have been in the resolution process. So obviously there will be a write back, and it will be you will settle the loan at 35, 45, 50, whatever. The rest of it has to be written back, potentially written back. And the tax laws are such that this can potentially lead to taxability, either under Section 41 of the Income Tax Act or Section 28 itself, of the Income Tax Act. There is a potential of that taxability. We saw in the roadmap, they have even in the IBC process, there have been significant haircuts in the recent times, and as I said, if that haircut was to again come with a rider or a burden of a tax on that haircut on the company, on the corporate debtor itself, it will make it resolutions almost impossible. Uh, Theoretically, the tax liability or tax implication would depend upon the nature of the loan, etc., or and the purpose it was used. But obviously, one would say that in the ideal situation, if you have taken money and you burnt it, I mean, you expensed it out. Either you have bought a fixed asset, or you have used in the operational expenses. So, if you've used in a fixed asset after the Mahindra and Mahindra case, or I would say even before that, the write back of that amount of loan should not be taxable. If you have used it for operational purposes, that should be a tax loss available to you. So even if the write back of that loan results in an income, you should be able to set off against that available tax loss. But that's not always true, right? That's not always true. There are several instances where the tax loss may not be available. For example, if it's a stressed company, it's been going for a long time, the losses may have expired. For example, it may have been older than 8 years, or the losses may not have been allowed by the tax authorities in the past years. So while you have burnt the cash or burnt the loan and incurred an actual loss, but they are not tax losses available to you. Or you're busy fighting various battles to keep the promoters of the corporate debtor were busy fighting various battles, and they could not find the tax return in time, for example, which would result that the loss that are expiring. So these are some of the easy examples. There can be several other instances where you may have used the loan for the operational purposes, resulting in a loss, a real loss, but they are not tax losses available to you when those loans are written back and resulting in tax. Also, the availability of brought losses. I mean, what's important, which I mentioned in the relaxation that came in 2018, the availability of these brought forward loss itself. So once that company gets acquired by a resolution applicant or successful resolution applicant who wins the bid, the shareholding changes. So Section 79 will disallows or does not allow the losses to be utilized by the new owners. The law provides a dispensation that if you acquired a company through an insolvency process, that does not, you still be available, but it provides an opportunity to the PCIT also, opportunity of being heard. Now imagine if he objects to it and is successful, and the losses are not carried forward by the insolvent company, and there are haircuts. Obviously, there are haircuts, and that haircut results in a tax liability on the company which is getting acquired. This would surely result in a tax exposure. I mean, would anyone want to acquire a company where he knows that whatever value he offers to acquire that company, there would be an additional potentially huge tax liability attached to it because of the write back and the losses not being allowed? This will definitely make the acquisition unviable. If the acquirers or the acquirers in general, a lot of people who are looking to for organic growth and looking at turning around sick companies or stressed companies as a way of acquiring or their inorganic growth plans. But if they have to live with this uncertainty of tax, it will result in fewer companies coming up to acquire companies. There will be fewer turnaround stories, and it will actually push these insolvent companies towards liquidation. If there are no bids, there would be liquidation. And if there is a liquidation, there is a loss to everyone. I mean, there's loss to all stakeholders. We know why is the reason that the liquidation value or the asset value is always the lowest, and the value of any business as a going concern is higher. So everyone faces stares at a loss or comes at a loss if a company is resolved by way of dissolution or by liquidation, and everyone includes tax department also. While while as I said, the tax demands that's also are treated like an operational creditor, so they also have to follow. They come into the same water in the waterfall also, and in respect to rights also, they are treated like an operational creditor. So while the IBC law provides for the settlement of all admitted claims, the claims which are admitted, right? But there is no clarity of what happens to the tax claims when the litigations are going on. It's a continuous process, right? It's a running company. So what happens to litigations which are going on and where the demand has not been raised or not been finalized? So that there's no clarity on that. And then, the perhaps the most interesting aspect of it is with respect to the deeming provisions here, deeming provisions, which is there in section 56 to 10 and 56 to 7b, right? So 56 to 10, as we know, is it creates it creates redeeming fiction and tends to tax the difference between a fair market value meaning a prescribed fair market value as prescribed in the as income tax rules with the purchase price, and it tends to tax the difference. As per 56 to 10, right, the fair market value of securities still has to be calculated as per the rule 11 UA of the rules, and where the stock, in case of listed companies, it's still it takes you to the stock market price. I mean, there are it's benchmark. Let's put it put it simply. It still benchmarks it against the stock market prices. Now, if you have received the shares at a value lower than that, right? If the acquirer receives the shares at lower than that value, the differential is taxed in the hands of the recipient. There is a relaxation on the applicability of the same section with respect to acquiring the shares of an unlisted company, unquoted shares. But surprisingly, this relaxation is not available for listed shares. Now, why I say surprising? Because the parent law, right? If it's a listed company, the securities have to be, it's fully regulated, right? The listed issue of listed security is governed by ICDR, SEBI regulations, and which itself provides a dispensary. There are valuation norms in any case for issue of listed securities, but those valuation norms are dispensed. The entire chapter 5 of ICDR is almost entire, not entire, almost the entire, including the valuation norms for issue of listed securities, are not applicable for companies under IBC. However, the tax laws still want to benchmark the value of shares received with the stock market price. Now, we've all seen that the stock market price of companies under IBCs are not a true reflection of their value. Since immediately after the acquisition or at the time of acquisition, the public float, the shares which are free floating, are so small that the price discovery mechanism of these shares fail. SEBI only a few months ago, into 2021, made substantial changes in for companies going through IBC because of this. The tax laws should also take a cue from the parent legislation with respect to issue of shares, and not try to benchmark stock market prices with the value at which the shares of an IBC company are issued to the acquirers. This law itself would the law, let's say the lack of dispensation itself, will deter acquirers from making bids to acquire listed companies under IBC, or at the very least to keep it listed. Which again, as I said, would result in most cases may result in loss of value, and including loss of value to the department. I'm just pausing to see if there's any question that I can take up now. Okay. Yes, the presentation would be shared. I think Aman said that in the beginning. Okay. I think I'll take some of the questions. There are quite a few. Some of the questions will take up in the end. Similarly, this was on the recipient side of recipient of shares. Similarly, if there are issue of shares, and that issue of share is at a premium and that premium is excessive compared to the valuation norms which are there in the tax laws. In case of unlisted company, the earlier one was what with respect to listed companies. This is for the unlisted companies. On if the premium is more than the prescriptive valuation of that company, that excessive premium is again taxed in the hands of the company which is issuing the shares. Now, in a resolution process, there are unviable debts, right? And there are unviable debts which can't be repaid, and in a lot of cases those debts are discharged by issue of shares. You issue shares to parties, whether after assignment, before assignment, you issue shares against those those payables. And because there's unviable debts, there would be issue of shares will be at premium. Now, there is being no dispensation available for companies under IBC on the application of taxing such premiums would again result in the resolutions being unviable. Also, the resolution professional sometimes may seek to resolution professionals who are who are professionals regulated profession by the IBBI, who are running the process. They may decide to hive off or sell certain assets of the company or to be able to sustain or to get some cash, or that's what they think is the most viable way or the most interesting way in which to get the maximum value for the business of the company. Now, that such transfer is again taxable. There's no provision to not tax it. There are other deeming provisions, 50C, 43CA. I won't go into detail of that. They are with respect to transfer of land, building, etc., etc. They are still taxed. Because what I feel is that if there is in an IBC process where most of the thing is happening through a public bid process, you're bidding through a very, very regulated process and under the watchful eyes of the tribunal, it is actually misplaced to benchmark that sale against any other fair market value. If you're going through a bid process, this is what the market is. This is what the goods are fetching. Why do you have to compare it with an artificially made value? So that's the key thing, that if something is going through a regulated bid process, that value is the best value that asset fetches. Why you don't have to question that? I mean, that's there are restrictions. You can't sell it to a related party. There are quite a few restrictions. So everything, there is no collusion. So these anti-abuse or deeming provisions should not be applicable in any aspect of a company going through a resolution process. Now, just another thing is that if you, for example, if you transfer an asset, that's what I was saying. If you transfer an asset during the resolution process to get some cash, and there is a tax liability, right? The tax liability, there's lack of clarity in how that will be dealt with. Had that sale happened before the insolvency happened and there was a tax demand earlier, that tax demand you will be treated like any other corporate debtor. But if that tax demand happens while during the insolvency process, then there is a lack of clarity in how that will be dealt with. Section 79 is already I've spoken about, so I won't go through that again. Now, since we have, I think, potentially less time, so I've already spoken about it. What are some of the exemptions or some of the things that I would expect to see on Tuesday? Basically not to burden the resolution process with tax. if the company, resolution is process is an extraordinary situation where an effort is being made to a company which is not able to survive or is dying. The extraordinary situation requires extraordinary measures. So if there has to be special treatment for that. Whether I've already spoken about it, whether it's relaxation of MAT, not taxing right back of liabilities of loans, whether either under MAT or under the normal provision of the law that should not be taxed. If the losses are available, that's fine. But if there is anything else over and above that, because of the loss being unavailable, if you tax that, it's not going to it's going to make the resolution unviable. The carry forward of losses, that those should be available. There should not be any. Those riders also should be removed, giving an opportunity to the tax department to object to those. I think those riders should be removed. In either case, what do you mean? What exact opportunity is required? That should also be clarified. Obviously, the notices go to the department. Yeah, we've also talked about the issue, the tax, the presumptive way of taxing the issue of shares, right? Whether in the hands of the recipient or for receiving shares at a value lower than the fair market value in case of listed companies, or taxing excessive premium when resulting from conversion of a loan to equity. In case of unlisted companies, these again these should not be. There should be a specific dispensation with respect to doing these. It's only a method of reviving the company. There is actually no premium being paid, and nobody is acquiring anything at a value lower than the actual market value. It's going through a bid process, and the SIC companies or the companies which are issuing shares are definitely not receiving excessive premium. These are only a way of discharging the liability. So, as I said, those rules, those prescriptive rules, straitjacket rules have been made for a normal situation, for a going concern company, business as it goes on. Those thresholds are being made from that perspective. You cannot apply that to this circumstance where you're trying to revive a company which is going through a stressed, which is stressed, and which is being revived through a very regulated process. GAR, again, the GAR, I mean, while it's so to say, it's still a very unknown level, but GAR is a tool which is there for aggressive tax planning. It's mostly it is intended towards aggressive tax planning and to curb tax evasions or tax leakages. Well, however, an IBC, is going through a resolution plan. As I said, it is going through the highest level of scrutiny. The institutions that are involved and the highest level of scrutiny that's involved in this process. We should not be still the danger of the sword of GAR should not be hanging. The CBDT circular specifically said that the court has explicitly and adequately considered the tax implications while sanctioning an arrangement. GAR will not allow such arrangement, but this is IBC process involves several factors. All stakeholders have to be considered. Tax is not the only stakeholder. It is trying to revive a company for a greater good. So for the for the economy as a whole. So if it is already going through that, it should not be subject. It should the sword of GAR should definitely be removed. So pretty much this is what I had to share. Obviously, these are neither exhaustive. Each of the items that I've talked about has got a lot of nuances. So I will try and take up a few questions. Mr. Shroff wants recording the session. In practice, we see no notices being sent to Mr. Sharma. No notice being sent. So actually, then you know, if you are a resolution applicant, you should insist for that notice being sent by the sent to the principal commissioner, so that he has an opportunity. Because obviously, if he contends that he did not have an opportunity of being heard, then the benefit of bought fraud losses would not be available. His question is that in practice we see no notices under section 79(2) being given by NCLT to PC. So, but yeah, as I said, you should insist as an applicant. You should insist that the notice is given to the PCIT. Mr. Thanagavilu, I think you'll have to discuss offline. It seems to be complicated. Says. Oh, the time limit and for so there is a I don't remember the section, but obviously the limitation, the time limit is expanded by the time of moratorium. So yes, obviously that notice can be sent to Mr. Sharma, other Sharma can be sent later. Mr. Katta Malikarjuna, his question is that if a company is acquired by an SPV incorporated for the purpose of acquiring, whether the change in the shareholding of SPV will hit the provision of Section 7. And I think you're talking about the reverse merger, right? So that actually that is not an IBC matter, but there are. I mean, the short answer is it should be available. Remission of liability to what extent taxable? Mr. Nitin Panchal, there is, you perhaps should read the Mahindra judgment, Supreme Court judgment. So, broad thing is that if it is if it's been used to acquire a fixed asset, the remission of that liability should not result in income. If it was used broadly, if it's been used for an operational expense, right? So then the remission of liability should result in income. But then if you use it for an operational expense, that loss should also be available, right? So it should be set off. Section 29A is followed in letter of spirit resolution process. Mr. Neetha Kurian, 29A prohibits, I mean, there are various parties who are prohibited. 29A of the IBC Code, they are prohibited from being a resolution applicant. I don't know how to, what do you want me, I mean, I don't know what answer to give. So it's letter and spirit. Yes, it's you have to give a declaration that you are eligible. You're not debarred under Section 29E. Which party are you talking about? Are you talking about promoters? Promoter of the erstwhile companies who are actually responsible for the companies being in this position. They putting decoy acquirers, etc. So I think those are beyond the scope of this discussion. Mr. Manisha, I think I did answer your question earlier. Yes, Devansh Soni, the PPT is going to be available. Amit KH, yes, it will be available. Mr. Anup Pandya, I haven't really understood you guys. This is Anup Pandya. If one has taken over a company in liquidation as going concern, how? So either you take over or it's liquidated. I mean, how can it be both? Puneet Garg. Yes, yes. So everything has. So what Mr. Puneet Garg points out is that there is a deficiency in capacity. I won't go to exactly what he's saying, but his deficiency in capacity with respect to right. So that we've seen everywhere, right? I'm not sure what's the age demography of this audience, but some of you may remember that there used to be FERA before FEMA came in. It was at a very different law. FEMA was a very different law than FERA, dealing with the same subject, foreign exchange. But the people dealing with foreign exchange, the people I wouldn't say RBI in particular, but obviously people, the man in the window whom you're dealing with, they remained the same. So they were still in the overhang of FERA. So it took time. That there is a learning curve for everything. There is a learning for everybody on this in this presentation. Similarly, there is a learning curve for the regulators also. So it takes time. Yes. So sessions like this will help, at least on this side. I think I've pretty much answered everyone. There were quite a few repetitive questions. Oh, there are more. Okay. What is eligibility? This again not a. As somebody wants to know an eligibility, or they Google what is the eligibility of becoming an IP. Actually, it's called an RP, not an IP. It's called a resolution professional, not an insolvency professional. This is exactly the point of this session, that the professional is supposed to resolve the company and not make it insolvent again. I think, Thangavelu, you've asked the question again. As I mentioned, that it seems to be, I mean, it's a complicated question. We probably need to connect offline. Whether GST has implication, IPC, which part? I mean, GST is a transactional tax, right? I mean, if the corporate debtor, the company, it keeps on selling goods, it keeps on paying GST. So, with respect to moratorium, etc., those may be available. I'm not really an expert on GST in any case. Please share specific case law. Pulavarthi Jitendra, which specific case law, which aspect? You can write to me. I will move the slide. It has my email address. You can write to me. I will send it. Yes, Mr. Chavali, yes, there is demands can be raised. That's exactly the point that I raised. After the moratorium period, after the resolution, yes, demands can be raised for the earlier. Not the demands already raised. They become like an operational creditors. But actually the topic of what happens to the income tax cases, which there are various categories. Let's put it that cases which were the demands which were already there before the insolvency process, cases which were going there before the insolvency process, and they related to period before the admittance, cases for the period during which the company was under insolvency, then demands for the period which was the company was insolvency. Note cases initiated after the insolvency process, but for the period before, after the claims were, after the case was admitted. This topic itself is a big topic. So there are some lack of clarity, but there are obviously judgment calls can be taken. So this itself, what happens to cases of what level? I mean, raised when and relating to which period? Each of these combinations that can be. That again is a separate topic, is a large topic. It can't be summarized. How to inform PCI? A notice can be sent. A notice, so I think under section 31, right? You file the resolution plan. Notice can be sent to the PCIT. So it should anyhow happen. So it should that notice should automatically go. If the law provides that the opportunity of being heard should be given, notice should automatically go. But we've seen it, right, in the mergers, amalgamation process, etc. Also, notices don't go, or you have to cause that. There is a liaison office also of the department in the tribunals. So when that what happens, it gets lost. So a lot of it is related to not being digitized system or a lack of manpower, etc. But it's your own interest as a resolution applicant. It's your own interest to make sure that the notices go. You can directly submit it also, right? Your resolution plan. If you're the applicant, you have the plan. Otherwise, the resolution plan is not a public document. So, but as an acquirer, you as a prospective as a resolution applicant, you definitely have your own plan. You can submit it. I think now I have answered everyone, other than the questions which kind of require another hour of session, or I haven't understood what it was said, what was being asked. So thank you so much. I hope this was interesting and useful. And pardon me if I was not able to answer any of your questions. As I said, this couldn't, an hour is too less a time to make it very exhaustive. Thank you so much.